In the high-stakes corridors of global finance, where $100 trillion in annual derivatives volume dictates the rhythm of the world economy, unprecedented collision is currently sending shockwaves through the Intercontinental Exchange, or ICE. While the market is accustomed to the volatility of Brent crude and interest rate fluctuations, the current standoff involving MeidasTouch, a prominent media network specializing in legal and political accountability, has crossed from a digital war of words into a full-scale institutional crisis. At stake is not just the reputation of the world's most powerful exchange operator, but the very integrity of the data services that underpin trillions of dollars in global assets. This conflict has escalated beyond mere commentary, threatening to disrupt the plumbing of the financial system as we know it. When an entity like ICE, which oversees the New York Stock Exchange and handles over 50% of global oil trading, finds itself at odds with a media force that commands millions of viewers, the resulting friction creates a unique brand of market risk known as reputational contagion. We are witnessing a situation where the gatekeepers of the global markets are facing a level of public and legal scrutiny that could force a massive repricing of corporate risk across the entire S&P 500. Welcome to Finance Unfold, your primary source for deep dive analysis into the systemic forces shaping our wealth and the global economy. As we unpack this developing storm between the giants of infrastructure and the disruptors of media, it is critical to stay informed on how these power plays impact your portfolio. Please take a moment to hit the subscribe button and turn on all notifications to join our community of over 500,000 sophisticated investors. We are curious about our global reach today, so please drop a comment below and tell us which country you are watching from. The Intercontinental Exchange is not just a building or a ticker symbol. It is a sprawling $100 billion behemoth that provides the essential data feeds used by every major central bank and hedge fund on the planet. Its influence stretches from the mortgage technology sector, where it processes nearly half of all U.S. residential loans, to the energy sector, where it dictates the price of the fuels that power global shipping. When ICE goes after an entity, it typically does so through the lever of institutional power, utilizing its vast legal and data-driven resources to assert dominance in the information space. MeidasTouch, on the other hand, represents a new breed of media influence that operates outside the traditional corporate framework. With a reach that often rivals major news networks, they have built a platform focused on exposing what they characterize as institutional overreach and corporate malfeasance. The current clash is being viewed by market analysts as a David versus Goliath scenario. But in the digital age, David has a megaphone that can reach every corner of the Bloomberg terminal. The catalyst for this recent eruption appears to be a series of investigative reports concerning the intersection of corporate lobbying and market data pricing. As MeidasTouch began digging into the proprietary algorithms ICE uses to facilitate high-frequency trading, the response from the exchange was swift and clinical. Legal filings suggest that ICE is seeking to protect its intellectual property, but the public perception is shifting toward a narrative of censorship and the suppression of financial transparency. This is not just a battle for the evening news cycle. It is a battle for the soul of market transparency. In the world of 2026, data is more valuable than oil, and those who control the flow of information control the direction of the markets. If ICE is seen as being overly aggressive in its pursuit of media critics, it risks triggering a transparency discount on its shares. Investors are already pricing in a 5% volatility premium as they await the next move in this legal chess game. Economically, the stakes are staggering. The data services division of ICE alone generates billions in recurring revenue, and any threat to its perceived neutrality could lead to a migration of institutional capital to competitors like the London Stock Exchange or the CME Group. We have seen in the past that when the neutrality of an exchange is questioned, the resulting exodus of liquidity can be both fast and permanent. The all hell breaks loose phase of this conflict began when leaked internal communications from ICE's legal department found their way into the hands of MeidasTouch researchers. These documents reportedly detail a strategy to use litigation fatigue to silence investigative journalism into the exchange's clearinghouse operations. This has prompted a rare intervention from regulatory watchdogs, who are now looking into whether these actions constitute an abuse of market dominance. From a professional trading perspective, the uncertainty surrounding this dispute is creating a bid-ask spread in the company's reputation. If you are holding ICE stock, you are effectively betting on the exchange's ability to maintain its monopoly on data while simultaneously fending off a media powerhouse that excels at public pressure. It is a precarious position for a company that serves as the bedrock of the U.S. mortgage and energy markets. Moreover, the timing of this conflict could not be worse for the broader financial sector. With inflation hovering near a 3.5% baseline and the Federal Reserve struggling to manage a soft landing, the last thing the markets need is a high-profile fight involving the very infrastructure that calculates the consumer price index data. If ICE's reporting is called into question, the entire foundation of our economic metrics could begin to wobble. MeidasTouch has countered the icy legal blitz with a massive public awareness campaign utilizing the hashtag #IceExposed to mobilize their millions of followers. This has led to a grassroots movement calling for a data audit of the exchange's pricing models. While a few thousand social media posts might not move the S&P 500, a loss of confidence from the major pension funds that own ICE shares certainly will. Institutional investors are currently in a wait-and-see mode, but the quiet conversations happening at Davos and during quarterly earnings calls are focused on one thing: risk management. The fear is that this conflict will pull back the curtain on the black box of exchange fees and data tolls, potentially leading to a legislative overhaul that could slash exchange revenues by up to 20% over the next decade. The legal teams at ICE are notoriously tenacious, having successfully navigated dozens of regulatory hurdles during their acquisition of Ellie Mae and Black Knight. They view MeidasTouch not as a media outlet, but as a disruptive force that threatens the stability of the global clearinghouse system. Their strategy is one of total containment, attempting to wall off their proprietary data from public scrutiny at any cost. However, the cost of this containment is rising daily. MeidasTouch has recently partnered with several whistleblower groups specializing in high-frequency trading, promising to release a series of data bombs that they claim will prove ICE has been overcharging smaller market participants for years. If these allegations gain traction, the all hell breaks loose headline will seem like an understatement. In the 20 years I have spent analyzing these markets, I have rarely seen an infrastructure giant go after a media organization with such public ferocity. It suggests that there is something in the MeidasTouch reporting that has touched a very sensitive nerve within the ICE executive suite. Whether it is a flaw in the clearinghouse risk models or a discrepancy in mortgage data reporting, the market is starting to sniff out a scandal. As we look at the numbers, the ICE surge in immigration and law enforcement activity, a separate but often confused namesake, has added a layer of geopolitical complexity to the narrative. Some reports suggest that ICE, the agency, is using ICE, the exchange, technology for surveillance, a claim that both entities have denied. Yet, in the court of public opinion, where MeidasTouch thrives, these distinctions are often blurred to maximize impact. The volatility in ICE's European derivatives market has already increased by 12% since the start of the year. This is a direct result of traders fearing that a data blackout or a regulatory freeze could be on the horizon. If the clearinghouse is forced to pause operations for an audit, the liquidity trap for Brent crude could see oil prices spike by $10 in a single afternoon. The plumbing of our economy is under pressure. When the pipes start to groan, the smart money starts to move. We are seeing a 4% increase in flight to quality assets like physical gold and treasury bonds as investors prepare for a potential systemic event involving the exchange. This is not just a story about a media fight, it is a story about the fragility of our financial foundations. The conflict between ICE and MeidasTouch is a microcosm of the larger struggle between centralized power and decentralized information. In this part of the narrative, the exchange has taken the offensive, but as any seasoned trader knows, the offensive can often be a cover for an underlying weakness. We are watching the order book closely for any signs of a washout in institutional confidence. The conflict between ICE and MeidasTouch is a microcosm of the larger struggle between centralized power and decentralized information. In this part of the narrative, the exchange has taken the offensive, but as any seasoned trader knows, the offensive can often be a cover for an underlying weakness. We are watching the order book closely for any signs of a washout in institutional confidence. The escalating friction between the Intercontinental Exchange and the media disruptors at MeidasTouch has moved from a digital skirmish into a high-stakes war of institutional attrition. As we move into early 2026, the data shows that ICE's clearinghouse, ICE Clear Credit, processed a record $28 trillion in notional value for USD-denominated credit default swaps in 2025, a 27% increase year over year. This staggering volume highlights the critical nature of the infrastructure that MeidasTouch is currently putting under a legal microscope. When the referee of the global credit markets is accused of using its data dominance as a weapon, the entire $2 trillion in assets benchmarked to ICE indices begins to look for an exit strategy. Welcome back to Finance Unfold, your essential guide to navigating the collisions between corporate power and public accountability. We are following every twist of this institutional standoff to help you manage the risks hidden in your portfolio. If you haven't already, please subscribe to our channel and join the 500,000 plus investors who stay ahead of the curve. Your support allows us to maintain the independent analysis required to call out these market giants. The Legal AF team at MeidasTouch has recently pivoted their investigative focus toward the ICE Mahwah data center, where billable kilowatt-hour usage surged by 50% in 2025. This facility is the physical home of the New York Stock Exchange and the nerve center for high-frequency trading in the United States. MeidasTouch alleges that the co-location services provided by ICE create an uneven playing field, where institutional giants pay for a millisecond advantage that essentially taxes the retail investor. ICE has responded with a series of protective legal filings, claiming that these proprietary arrangements are trade secrets vital to market efficiency. From a revenue perspective, ICE is currently firing on all cylinders, reporting a trailing 12-month earnings per share, EPS, of $5.52 as of January 2026. However, the Meidas factor is beginning to show up in the qualitative risk assessments of major asset managers. If the public pressure generated by MeidasTouch leads to a Federal Trade Commission, FTC, investigation into data monopolies, the 94% profitability rating currently enjoyed by ICE could be decimated by regulatory fines and mandated fee caps. We have already seen the FTC successfully intervene in the ICE Black Knight merger, proving that even this $100 billion giant is not above the law. The conflict took a bizarre turn when MeidasTouch began highlighting the confusion between the Intercontinental Exchange and U.S. Immigration and Customs Enforcement, commonly known as ICE. In a series of viral broadcasts, they pointed out how the ICE acronym is now synonymous with institutional secrecy in both the financial and civil rights sectors. In January 2026 alone, the agency version of ICE was accused by federal judges of violating over 96 court orders, a statistic MeidasTouch used to draw a parallel with the exchange's own lawless approach to data pricing transparency. Economically, the reputational contagion is spreading to the mortgage technology sector. ICE now controls the entire life cycle of nearly half of all U.S. residential loans through its Encompass and Black Knight platforms. MeidasTouch researchers are currently following a lead on proprietary data surcharges that they claim add an invisible $500 to $1,000 to the closing costs of every American homeowner using ICE-backed technology. If verified, these numbers would transform a media feud into a class action nightmare that could wipe out years of projected growth for the company's mortgage division. The market is currently pricing in a transparency premium. And while ICE CFO Warren Gardner prepares to present at the Buffet Financial Services Conference on February 10, 2026, the order books for ICE futures and options are seeing a 19% increase in average daily volume. Traders are betting on volatility, not stability. When an infrastructure company is forced to spend more time in the courtroom than the boardroom, the efficiency of the plumbing begins to erode, leading to wider spreads and higher costs for everyone in the ecosystem. MeidasTouch has mobilized its Meidas Mighty community to file thousands of FOIA requests and public comments regarding ICE's environmental, social, and governance ESG ratings. They are questioning how a company can maintain a high ESG score while simultaneously being accused of suppressing investigative journalism. This ESG attack is particularly dangerous for ICE because trillions of dollars in passive fund assets are mandated to invest only in companies that meet strict ethical benchmarks. A downgrade in their governance rating could trigger a forced liquidation of millions of shares. The exchange's response has been to double down on its data and analytics solutions as a tool for maintaining compliance. ICE argues that their sprawling data ecosystem is what prevents a repeat of the 2008 financial crisis by providing real-time visibility into credit risk. They view MeidasTouch's attacks as reckless and potentially destabilizing to the very markets that keep the US dollar dominant. This narrative of market stability is the exchange's primary shield against the populist arrows being fired from the MeidasTouch media fortress. In the 2026 investment landscape, the cost of chaos is a real metric. For ICE, that cost is currently measured in the 31x price-to-earnings ratio they are maintaining compared to Nasdaq's 34x. The Meidas discount is the gap between where ICE is trading and where a controversy-free exchange operator should be. Institutional holders like BlackRock and Vanguard are reportedly pressuring ICE leadership to settle the narrative before it impacts the fourth quarter 2026 guidance. As we look at the specific legal filings, ICE has recently moved to quash subpoenas from third-party groups allied with MeidasTouch. They are using a fortress strategy, attempting to prevent any internal emails regarding market data surcharges from reaching the discovery phase of litigation. However, MeidasTouch has recently added veteran legal analysts to their team who specialize in whistleblower protection, suggesting they are preparing for a long-term siege rather than a quick skirmish. The all hell breaks loose scenario for ICE would be a coordinated data strike by retail traders, where a critical mass of users moves their volume to competing venues like the IEX, Investors Exchange, to protest ICE's pricing models. And while the big banks provide most of the volume, the retail revolution of the last few years has shown that collective action can force even the largest institutions to the bargaining table. MeidasTouch is currently the most effective megaphone for such a movement. Moreover, the energy transition data that ICE prides itself on is now being scrutinized for greenwashing. MeidasTouch has alleged that ICE's environmental markets are designed to favor large polluters by providing opaque carbon credit pricing. Since ICE handles the vast majority of global carbon futures, any doubt about the integrity of this data threatens the global effort to price carbon. The stakes have moved from homeowner costs to planetary survival, a shift in narrative that is pure gold for a media network like MeidasTouch. Institutional traders are noting that the volatility of sentiment around ICE is now higher than the actual volatility of the Brent crude they trade. This disconnect is a classic sign of a reputation trap. In a world where perceptions drive flows, a media network with a 4.9-star rating on Apple Podcasts and millions of YouTube subscribers can be more dangerous to a stock price than a 10% drop in oil demand. ICE is fighting a 20th century legal battle against a 21st century information war. The commitments of traders reports for the last few weeks show a subtle but steady increase in short interest for ICE stock. This suggests that the smart money is beginning to hedge against a negative outcome in the MeidasTouch standoff. If the media network can prove even 10% of their allegations regarding data tolling, the resulting regulatory backlash would be a Black Swan event for the entire financial services sector. As the CFO of ICE prepares for his upcoming presentations, the market is looking for more than just earnings numbers. They are looking for a strategy to de-escalate the Meidas conflict without ceding the proprietary data advantages that make ICE so profitable. It is a narrow path to walk, and any misstep will be instantly broadcast to MeidasTouch's global audience, creating a feedback loop of negative sentiment that could haunt the exchange for the rest of 2026. The tension between infrastructure and information has never been higher. When the gatekeepers of the market go after their most vocal critics, they often end up shining a spotlight on the very secrets they were trying to hide. We are witnessing the first great data war of the 2020s, and the outcome will determine how much you pay for your mortgage, your gas, and your stock trades for years to come. In the final hours of this unprecedented institutional clash, the all hell breaks loose scenario has moved from a theoretical market risk to a concrete structural crisis. As we stand in early February 2026, the Intercontinental Exchange, ICE, is reporting record open interest of over 114 million contracts, a 20% surge that highlights the sheer scale of the system now under fire. While ICE celebrates these milestones as a testament to deep liquidity, MeidasTouch has reframed this growth as the expansion of a data cartel. The sheer weight of $28 trillion in credit, default swap notional value handled by ICE Clear Credit serves as the ultimate high-pressure environment for this battle, where a single court ruling or regulatory pivot could trigger a historic repricing of the exchange's $100 billion valuation. This conflict is no longer just about fee transparency or media accountability. It has become a struggle over the digital sovereignty of the global investor. As MeidasTouch founders Ben, Brett, and Jordan Meiselas leverage their network to expose what they call the secret surcharges of the mortgage industry, ICE finds itself in a defensive posture that traditional corporate PR cannot resolve. We are seeing a 19% increase in protective hedging among major institutional holders, a clear sign that the market is bracing for a Black Swan event where the legal costs and reputational damage finally outweigh the exchange's formidable recurring revenue streams. The turning point in this saga occurred when MeidasTouch connected the dots between ICE's dominance in the environmental markets, which topped $1 trillion for the fifth straight year, and allegations of opaque pricing. By positioning this as a matter of planetary integrity, the media network has successfully bypassed the financial trade press and reached the global ESG, environmental, social, and governance investment community. This move has put ICE's governance score under extreme duress, potentially triggering a forced divestment from passive funds that are legally required to dump companies embroiled in such high-level ethical disputes. At the same time, the confusion surrounding the ICE acronym has reached a fever pitch. In late January 2026, as the U.S. government entered a partial shutdown over immigration funding, the media narrative around the law enforcement agency and the financial exchange became inextricably linked. MeidasTouch utilized this atmospheric chaos to highlight a culture of secrecy that they claim defines both entities. This strategic blurring of lines has turned a niche financial dispute into a populist movement, drawing in millions of viewers who may not understand derivatives, but deeply understand the concept of institutional overreach. The financial data supports the gravity of the situation. While ICE CFO Warren Gardner prepares to address investors at major conferences in February 2026, the company's internal metrics show that late-stage mortgage delinquencies have hit a near 3-year high. This softening in the underlying credit market, combined with the Meidas factor, has created a pincer movement on the exchange's stock price. If the plumbing of the mortgage market begins to leak at the same time the publicity of the exchange turns toxic, the resulting washout could be the largest the sector has seen in 2 decades. In response, ICE has deployed a fortress defense, utilizing its vast legal resources to quash discovery and limit the scope of third-party subpoenas. They argue that their proprietary data models are essential to market stability, and that any forced disclosure would jeopardize the entire global clearinghouse system. This systemic importance argument is their strongest shield, yet it is exactly the kind of too-big-to-fail narrative that MeidasTouch excels at dismantling for their audience. The professional investment community is now watching the basis trade between ICE's futures and the underlying spot market. A widening of this gap would indicate that the market no longer trusts the tape provided by the exchange, a catastrophic outcome for a company whose entire value proposition is based on price discovery. We are seeing early warning signs of this in the European natural gas markets, where volatility has spiked by 12% in direct correlation with the latest MeidasTouch investigative broadcasts. Ultimately, the clash between ICE and MeidasTouch is a preview of the information wars that will define the next decade of finance. The days when an exchange could operate as a quiet utility are over. In the era of 2026, every tick of the market is subject to public scrutiny. Whether you are a retail trader or a multi-billion-dollar fund manager, you must recognize that the political risk of your assets is now just as important as the financial risk. The all hell breaks loose headline is a reminder that in a hyper-connected world, no institution is too powerful to be challenged. From the Mahwah data center to the halls of Congress, the battle for data transparency is being fought in real time. By staying diversified and keeping a close eye on the reputational metrics of the companies you own, you can protect yourself from the cascading failures that occur when an infrastructure giant loses the trust of the public. Thank you for following this deep dive investigation on Finance Unfold. To ensure you never miss an update on the systemic shifts that threaten your wealth, please hit the subscribe button and click the bell icon for all notifications. We are committed to bringing you the professional, fact-based analysis you need to thrive in these volatile times. Join our community of over 500,000 investors by subscribing today. And remember, in the world of finance, knowledge is the only asset that truly cannot be manipulated. This is Finance Unfold, signing off.